Hello everyone, welcome to my channel. This is Sarthak and today's video is on ways to save tax on capital gains. So if you're new to my channel, just letting you know, I've started a series on personal finance, and if you've not checked out the first video, you can click on the I button on the top right corner and check it out. So I wanted the first few videos of this series to be more basic so as to get you guys a good understanding of personal finance. But since the financial year is ending, it made sense for this video to come out. So let's check it out. So let's start with what is capital gain. So capital gain is the net profit that an investor makes after selling a capital asset. Now, a capital asset can be a range of things like property or jewelry, or let's say stocks or mutual funds. So in this video, we are only going to talk about the capital gain on stocks and equity based mutual funds. So depending on the tenure of holding an asset, it can be classified as either short-term capital gain or long-term capital gain. So if the tenure is less than 1 year, then it is called short-term capital gain and the tax on it is 15% of the gains. So let's go through an example. Let's say you bought Reliance shares on 1st January 2021. The buy price was 100 and the quantity was 10. And let's say you sold all of them on 1st March 2021. So the period of holding the asset was 3 months and the selling price is 150. So the short-term capital gains will be around 500 and the tax liability will be 15% of 500, that is 75. Now, if the tenure is more than 1 year, then the capital gain is called long-term capital gain and the tax on it is 10% of the gains above 1 lakh rupees. So let's again take the same example. Let's say you bought Reliance shares on 1st January 2020 and the buy price was 100, the quantity was 3000, and let's say you sold them all on 1st March 2021. So that is the period of 1 year and 3 months, which is more than 1 year. So it will be classified as long-term capital gain and the capital gains will be 1,50,000. But the tax liability will only be on the gains above 1 lakh, which is 50,000. So the tax liability will be 10% of 50,000, which is 5,000. The first method of saving taxes on capital gain is called tax harvesting. The simple funda of tax harvesting is booking long-term capital gains up to 1 lakh and reinvesting it. Now, if you do it every year, you can save up to 10,000 rupees of taxes on capital gains. So let's again take an example. Let's say you bought Reliance shares on 1st January 2020. The buying price was 100, the quantity was 3000, and the current price is, let's say, 150. You want to hold this share for long term because you feel it will give even more profits to you. And currently you have an unrealized long-term capital gain of 1,50,000. So what you can do right now is you can sell 2000 shares and then maybe rebuy them because you want to keep your portfolio as the same. And what happens is you have realized long-term capital gains of 1 lakh rupees, and if you remember, there is no tax liability till 1 lakh on long-term capital gain. So the tax liability here is 0. So that's the way you have saved up to 10,000 rupees of tax this year. So most of the platforms for mutual funds or stock, they have a way for you to look into the classification of long-term and short-term capital gains so that you can then maybe decide to harvest some long-term capital gain. For example, on Grow, you can go on investments, then mutual funds, then portfolio insights, and down here you will find this distribution of funds spread by capital gain and long term and short term capital gain. You can click on the long term and see which all mutual funds are having the long term capital gains. Now, the second method of saving tax on capital gains is setting off gains with losses. So capital gains can be set off with capital losses. In a way, you can say they can be cancelled out. Now, short-term capital losses can be set off against both short-term capital gains and long-term capital gains. but long-term capital losses can only be set off against long-term capital gains. Let's again take an example. So let's say your short-term capital gain is 30,000. Your current tax liability will be 15% of the short-term capital gain, which is 4,500. But let's say you also have an unrealized short-term capital loss. By unrealized, I mean you have capital loss, but you have not sold the capital asset, which can be a share, yet. So let's say you have an unrealized short-term capital loss of 20,000. If you book that loss, by booking the loss, I mean you sell the share and you have a loss, which is realized now. Then the adjusted short-term capital gain will be 30,000 minus 20,000, which will be 10,000, and the tax liability will come down to 1,500. Now, what you can do is you can reinvest on the shares that you sold to realize the capital loss if you want to keep the portfolio the same, but now you have to pay lesser tax than you had to pay before. So this is another way you can save on taxes you pay this financial year. Maybe you'll have to pay the taxes that you have set off this year in future financial years, but in this financial year, you'll have to pay much lesser taxes. So if you use Zerodha for stocks, then there is a good way in Zerodha to know if there is an opportunity to set off capital gains with losses. So what you can do is you can go on console and then reports and tax loss harvesting. So tax loss harvesting is another term for setting off capital gains with capital losses. So if you see, it is showing you short-term tax loss harvesting opportunity, and it also shows you the realized short-term capital gain and unrealized short-term capital loss, which you can use to set off the capital gains. So that is all for today. Please stay tuned for more videos on personal finance. Do mention in the comments if you have any doubts or any topic you want a video on. And also don't forget to like, subscribe and share this video. Thanks for watching.